All right, so we are about to watch Jerome Powell. The Federal Reserve is about to deliver their interest rate decision on whether or not they're going to keep interest rates the same. So we're going to get that done here. Get you all set up. Give me 1 second. I'm going to watch Federal Reserve live. And we got it here. Get my ugly mug out of the way. You guys can watch it here. Let's see what they got to say. More than likely,
Low competition keywords.
They're going to keep interest rates the same. However,
content with powerful AI.
the comments afterwards on whether they're going to be, hawkish or dovish on the interest rate decision, or moving forward for 2025 for the most part, it's kind of imminent that they will pretty much keep rates the same today. There's almost a 0% chance of them raising or lowering interest rates today. But what we really want to see is what their plan is for 2025. So we are about a minute away. So I'm going to get me off the screen completely. Let's see what they got to say.
About a tenth of 1% on the S&P. We're very, very close to all-time highs. This is not where we thought we would be. To Mohammed's point, at the start of the year, we had March penciled in. Many houses did, looking for a rate cut in March, and very close to 470 on a 2-year. With your Federal Reserve decision this afternoon, we can cross to DC with Mike McKee.
The Fed sees higher growth, stronger inflation, and slightly lower unemployment for 2024, but officials still barely see a median of 3 rate cuts for 2024. 9 of the 19 members, however, said they thought 2 or fewer rate cuts would be appropriate. 10 saw 3 or more. They did not change rates today. The dots move up a little bit next year. The median sees 2 cuts to 3.9% in 2025 instead of 3 cuts, 3 more to 3.1% in 2026, a slightly shallower path. The committee's median long run, the natural rate, also moves up to 2.6%. GDP is projected to increase 2.1% this year, a significant upgrade from the 1.4% in the December forecast. Growth is also higher in 2025 and 2026.
The biggest thing for this will be
Unemployment
Jerome
will end
Powell's
this year at 4%, Fed officials now say, instead of 4.1%. And core PCE inflation will fall, but only to 2.6% instead of the 2.4% seen in December. Headline inflation unchanged at 2.4%. The only change to the statement is job growth is no longer characterized as moderating. Language about considering any adjustment to the target rate, commitment to the 2% inflation target is the same. The decision was unanimous. And finally, there was no mention of the balance sheet in the statement beyond keeping the $95 billion in Treasury and mortgage rate caps each month.
Mike McKee, I'm going to turn to the price action in a moment, but I've got one question I need to ask you right now. Let's go through what you just said again. So faster growth, lower unemployment, higher core inflation, then something jumps off the page. It's exactly the same median dot with some changes around the surface, I know, in and around. It's more nuanced than that. But ultimately, the exact same median dot than December, as December. Mike, can you make sense of that? How have we just revised growth higher, revised unemployment lower, and core inflation up for 24 and left the median dot unchanged?
Well, you have to look at it as the median dot, because others did change their views around that dot, but nobody moved significantly higher to push rates up. One person did. They needed 2 to move it up, to move the median rate up. But as I noted, 9 of the 10 now say 2 cuts or less. So it is certainly possible, if we see similar inflation and jobs numbers going forward, that this could change again. And at the next meeting in June, when they put out out a new forecast, they could go to 2.
I guess no wonder people are buying stocks right now. Mike, we'll come back to you in just a moment. On the S&P 500, positive by a third of 1%. Here's the price action for you. Stocks higher. On the Nasdaq, up by 0.4%. In the bond market, a rally at the front end. We're down about 4 basis points to 464 on a US 2-year yield. And the dollar a little bit weaker here. The euro at 108.85. Brad, my first reaction to this, just to see faster growth for 2024, lower unemployment and higher core inflation, and a median dot. And we can get into the changes beneath the surface, I know, but a median dot that's unchanged in the face of all of that. If you're in equities at the moment, that sounds pretty bullish to me, doesn't it?
This is a Federal Reserve that suddenly, under the hood, seems to be accepting higher than expected inflation for a longer period of time, taking longer to get down to that neutral rate, because there is no other way to interpret all the numbers that you just laid out: hotter inflation than expected for the next couple of years, faster growth, and the fact that they're still planning for similar types of cuts highlights where the bias is right now for a Federal Reserve that still does want to cut rates.
If you're just tuning in, joining us around a table, Mohammed El-Arian is alongside us, together with Priya Misra, fixed income portfolio manager at JP Morgan Asset Management. Priya, I want to cross over to you. Just your first thoughts on the projections and the statement that we got just moments ago.
I think this is a Fed that really wants that soft landing to continue. They saw a path of that for that soft landing. Now, we have had better inflation data, higher inflation data than the Fed would have liked, I think, the last 2 months. But it's 2 months. You know, you just go back 4 months. We had really weak inflation data in November and December. Jan and Feb came in a little higher. I mean, it was never going to be a straight line down to 2%. I think the Fed is saying we're going to be patient. There's a long time between now and December. Those projections are December projections. That growth getting higher, I wonder if they're telling you the supply side's working, whether it's population growth, whether it's supply chains coming back. That's allowing growth to be strong. That's allowing the labor market to be okay. And the Fed is saying, be patient. We're going to get close to that 2%. It might take a little bit longer. We can start normalizing.
Well, it's fueling a rally in gold. Gold is up by 0.6% off the back of some of this. Mohammed, your thoughts on what we've just heard from this Federal Reserve?
So I would have agreed with everything that she said, with one exception, which is a revision up in the PCE core to 2.6. So that puts me more in Lisa's camp. I think this is a signal, and the market is taking it as that they will tolerate slightly higher inflation for longer.
10-year Treasuries looking
This is a reason why maybe if you look incrementally under the hood, you're seeing some inflation expectations over the longer term start to pick up just a little bit. Priya, from that point of view, does this kind of call, all things being equal, make you less enthusiastic about longer term Treasuries if it seems like this is a Fed that wants to stick the soft landing regardless of what the data might be suggesting and even their own projections?
I would say the belly of the curve is still the most attractive, because, you know, whether they cut 2 times or 3 times, let's look at the total amount of cuts that's priced in. The neutral rate that the market is expecting, or the end point, is 375. I mean, the Fed's neutral rate is 2.5. The market is well north of that. So the part of the curve that's the most, I'd say, sensitive to the totality of rate cuts is that 5 to 10 year part. You're right. Going out into the 30-year, there's term premium, there's supply demand. But I will say, if the soft landing continues, that $6 trillion sitting in money market funds starts to go into bond funds, equity funds. That's a positive for duration as well.
Mohammed, I have to say, this idea of potentially inflation being higher for longer, when is it kind of a sort of tacit acceptance of 2 point something you've talked a lot about, rather than looking for 2% as even a goal? If it takes 10 years, are we talking about 2% as the target anymore?
No, if it takes 10 years, then we're not talking about 2% anymore. I think you're getting that tacit agreement that in order to achieve the soft landing, we have to redefine what we think is the inflation rate that goes with that soft landing. It is not 2. I think it's nearer to 3 than it is to 2. And I think that this is a first step in this process.
I wish that these forecasts came out before the semi-annual testimony, because I do wonder how different the questions would have been. There would be serious questions now about how serious they are about getting inflation back down to target. Lisa, I think we have to go through these numbers. If you're just joining us, here they are. So I'll give you the number now, the forecast for 24, and you can compare it to December. As Mike McKee explained quite clearly, these are the median projections. 2.1% for GDP for 24. In December, it was 1.4. The unemployment rate for 24, 4%. In December, it was 4.1. PCE, 2.4, December 2.4, core PCE 2.6, December 2.4. The median dot for this year unchanged at 0.6, implying 3 cuts. Now, Bramo, if you put that in front of any committee, any press conference, the obvious question for any journalist today, this afternoon, is how serious you are taking it to get it back to 2%. Because based on that, I mean, what are you taking seriously? And I think you absolutely nailed it. Are they beginning to tolerate something a bit above target?
Because ultimately they want to prioritize the labor market over inflation data that is noisy, and they've talked about that in higher than expected. I will just say, if it came up for semi-annual testimony, I wonder if they'll ask about Bitcoin, because they probably wouldn't read it and then ask that question. But I'm glad that we have good journalists who are going to be asking that question in the press conference.
I think Senator Warren also sent another letter recently saying you should cut rates like right now.
Maybe they're listening.
Yeah, I'm sure that won't come up in the news conference a little bit later. Joining us to discuss this one is Dan Swonk, the chief economist at KPMG, alongside Bank of America's Michael Gapin. Dan, I'd love your reaction just to these projections and what you've heard so far.
Let's check in on my buddy Kevin. He's like, if you guys don't follow him, you need to, because he's the best YouTuber in the game.
Inflation and more growth than we previously thought, and it's a measure of—
Yeah, the 210 is steepening. You're at negative 36 now. Previously, you were at about negative 42.
Our forecast, or the average official doesn't have to change their forecast. I think that's how he'll probably respond to that question, but I think it's coming out. I just want to remind folks, there's another shoe to drop here, an important shoe. We know the Federal Reserve began discussion, we were told anyway that they would, of the potential end to the reduction of the balance sheet. And so we're hoping to get some information, some details about when the Fed might bring quantitative tightening to a close here, having brought the balance sheet down by $1.5 trillion. It's still remaining. If it keeps going at this pace for another year, it would even stop at $2 trillion above where it started this whole thing back in 2020.
CNBC just has so much better coverage.
Very interesting stuff. And if I can go back to David Kelly, when we're talking about the balance sheet, we don't have the details. As Steve said, maybe we'll get some here in the press conference. What feels appropriate to you, knowing what we do about where the Fed stands right now? What should the timeline look like, and what can the market take?
Well, I think what's really interesting is the Federal Reserve really doesn't know how far they can push down that balance sheet before they have a repeat of what happened back in September of 2019, where short rates suddenly bounced up. They're using this ample reserves regime. It's right now, it's abundant reserves. They've got all these reserves. So they're gradually draining reserves from the system, but they don't know how far they can go. And they're really making some guesses here. I've seen some research coming out of the St. Louis Fed saying that maybe if you get reserves down to between 10 and 12% of GDP, that might be right. But it seems to be very loose logic. But if they do that, yes, go ahead.
Maybe you can answer a question for me. If they have the standing repo facility, which is like something you can, break glass in case of a fire here. In other words, if they don't have reserves, they can go to the Fed for those reserves. What's the difference? I'm trying to figure out a reason to be concerned the Fed could go too low on the balance sheet if this standing repo facility is something that really exists and will work. Why should I be concerned?
I agree with you. I don't think they should be so concerned, but I think they're worried that they will get blamed if they have a repeat of September 2019. There's no reason.
Oh yeah, of course. I remember September 19th very clearly because I was with Jordan Belfort. I did an interview on his podcast, and all of a sudden there was a lack of liquidity, and basically overnight rates skyrocketed to like 7 or 9% or something crazy when it was supposed to be like 0. And so the Fed's like, oh my gosh, we got a big problem here. Okay. I'm trying to reconcile this. This is, I have to just sort of think about this just logically for a moment. So let's think logically here. Okay, so what we just got is a signal that so far says 3 cuts still here for 2024, but no time certainty, right? Could all be later than expected, maybe even Q3, right? Q3 is July, August, September. Okay, then we have rates may settle long-term higher than we previously thought. That is, we made a video specifically about how this could happen, how they could end up jerking up that long-term rate. But my thought was, why do that now when you could just do a little tug over here? So they gave us the tug somewhere I wasn't looking. Like, I feel like I was looking at the rug. Like, I'm looking at the rug going, they're going to rug us right there. Right there. That's where they're going to do a tug. They're not going to pull us off. They're not going to rug pull us. But the tug's coming right there. And then before you know, it's like, well, bro. It comes from way behind you. That was unexpected. So, and I'm trying to understand why. Like, the logic of this. So, the logic of this must mean that, basically, they think are we strong enough, like, must mean high enough now, or even above 4.5% to bring the last mile down, right? This is all about sort of the last mile. Can we get the last mile down at even 4.5% rates, right? Which would be with 3 rate cuts. Okay, maybe. So can you get the last mile down? And then, must mean high enough now or even above to bring the last mile down. Let's see, I'm trying to think. But moving long-term up implies it may
Also,
take
does anybody
much
think it's a
longer
coincidence that,
to actually get to 2%.
Biden's impeachment hearing is the same
And
time
so
as
therefore
one of
they
the
might
most
need, rates
anticipated,
at 3% for way longer,
Federal
right?
Reserve
3 to
decisions
4%
of the
rates
last
for way longer.
5 years.
Maybe. I mean, consider they got rid of 2% on any forecast, which we expected that would happen, that they would go above 3. I thought they'd go closer to 3.3. That surprised me. This followed Bank of America. Bank of America nailed the 3.9 call. Bank of America actually nailed that call right there. Actually, did they nail it across the board? Let me see if they also nailed the last one. Bank of America. Bank of America. No. See, they thought they were going to go 2.9 on the further one and then 2.5. So Bank of America nailed the box right there. So, okay, now, as a play, oh man, it's tough. I mean, we went into this with a strategy with course members. This morning we created a strategy for what we would do based on what these numbers came in under, and most of it had to do with how we were going to place certain indices and certain options on it. But I know there are a lot of people who are asking about making a move on the interest rate sensitive. I know Enphase is up on this, like 3.3. I don't think that's going to be robust. I don't know. I think that longer term rate is a giant middle finger to the interest rate sensitives. It's a way of saying, F you if you think we're going back to 0% anytime soon. And unfortunately, I think that's going to be longer term damaging. I don't know though. I'm excited to hear Powell's commentary, but I'm a little surprised with this tugging. Let's listen into Bloom for a moment.
Yes, then it's not. But I think in the context of where we've been and what we're doing, this is sort of the way to think about it as a way to not cause undue pain in the economy for no reason.
So then I agree with you, and I think it's important that we're redefining patience.
1:30 Central, by the way.
Going into this meeting, patience meant there's no rush to cut rates. Now patience means we may have to wait a little bit longer to get to 2%, or the path will be slightly different. But whenever I say that out, the reaction, the pushback I get is, but that's going to destabilize inflation expectations. I don't think it will. Do you agree? Do you agree that it will not?
Yeah, I'm with you, Mohammed, on this. I don't think it will, because we've seen remarkably anchored inflation expectations throughout all this. Now, if it did begin to, the Fed would be changing its tune pretty quickly, right? So this is something they're looking at. They're looking at that inflation expectations have been fairly well anchored, and that's a good sign for them that this is an okay path to take. But you're absolutely right. If we were to see inflation expectations shift on the basis of this, they'd have to change their tune and their strategy.
Mike Gapin, I want to give you the final word going into this news conference. What would you look for?
Very well.
Well, I think that the balance, so what's been discussed here is essentially, do you really have a higher bar to start? Are you less confident about starting? We all seem to think that they still have a lot of confidence about disinflation remaining in place. So I would kind of address those two confidences. And honestly, I would try and tease out any information on the balance sheet discussion. The market, I think, needs to know, does taper start when overnight reverse repo balances are just low, or do we have to get to zero on that? I do think some information there would be helpful.
I think we'll be getting some questions on that, no doubt about it. Mike Gapen of Bank of America, the brilliant Diane Swank of KPMG. To the two of you, thank you. If you are just joining us, 13 minutes away from a news conference with Chair Jay Powell of the Federal Reserve. No change to interest rates, plenty of changes to the outlook for 2024. Faster growth, lower unemployment, higher core inflation, and then I guess the news is where there is no change. The median...
Switch over to these guys. He should be on here shortly. I'm going to put one more on here. Probably. I thought Yahoo Finance would have something, but everybody seems to be just playing the stage until he has it. So let's go back to Kevin for now.
This is bad for. That's my take. There's no, you can't look at it as good. Remember, the stock market is forward-looking. And
go back
same
to
trash. No. The real issue is that we are now seeing, we are starting the process of increasing longer-term rates. I think that's really bad for interest rate sensitive. Yeah, here we go. Nick T. A steady upward drift in expectations of the long-run Fed funds rate by committee members finally and barely lifted the median projection now to 2.625. That's bad. That longer term move up, I think, is bad for interest rate sensitives. I am bearish. You know, like the end phases, the Tesla, the interest rate sensitive. This is bad for. That's my take. There's no, you can't look at it as good. Remember, the stock market is forward looking. And what are we hearing forward looking? Yes, things might be a little better this year, but that line going down, like what's best case scenario for interest rate sensitive like the Teslas and the others? Best case scenario, let me paste this in here. Best case scenario is rates do that. Okay? That's best case scenario for your interest rate sensitive. Worst case scenario, or like the scenario we had going into this, was something like that. Okay? Now, what we're actually getting is something like that, where the slope of the line down flattens out. That's really bad. So that's bearish. I don't like that. Okay. All right. Well, that's my take on that higher term movement up. I don't know if the reporters are properly paying attention here, or if they're just not, or what's going on. But okay, fine. Okay, let's listen to Doomberg again.
Been trying to explain some sort of cohesive theory behind it and where we're going. Is that what this smells like? We're trying to sort of rationalize and come up with a theory behind this when it's really this person thinks this person thinks this. This is a good kind of happy medium. Go figure out what to do with this.
So if you want to be generous, you'd say this is such an uncertain economy. There's so many things changing on the structural side that they have no choice but to behave like they're behaving. If you want to be less generous, you'll say this is a Fed that actually took a view. It looked through data in 2021 and ended up really undermining its credibility. And therefore, it is very hesitant to do anything more than simply look at past data. So it's up to you whether you want to be generous or less generous.
The decision 9 minutes away. We'll find out if Robert Tipp is feeling generous of PGIM. He joins us now. Robert, you've had about 20 minutes to chew over this one. Your thoughts on it?
Yeah, I mean, I think that in terms of supporting what they've done, the rate of growth of the economy has been firm. The rate of inflation has come down at a headline basis by, 5-6%, by nearly 3% on a core basis. The question came up earlier, do they want a recession? I think they want a soft landing. And they got conditions restrictive enough to bring down inflation quite a bit. Wage growth has decelerated, and they've managed to do that, while unemployment has remained low, growth has continued. So I think it's been a very successful go. Did they start late? They did start late. But I think their pandemic practice, was a little bit late. I don't think
okay, pandemic practice. Okay, let me see what some of the other suits are saying. Again, 5-year break-even inflation rate actually just is now, no, okay, I don't have the latest update on that. I do have the latest update, though, on the 10-2. 10-2 yield curve steepening. That makes sense. No, it actually does. It does look like the 5-year break-even rate is stable up. So the 5-year break-even rate didn't get pushed down here. You've got indices are green across the board. Gold is up on this. You've got the
10 years.
ooh, yeah, the 10-year just realized it. So, okay, the 10-year just realized, it's not me saying this, the 10-year just realized this is bad for interest rate sensitive. Okay, so what just happened on the 10-year? When the decision came out, oh, this is crazy. This is crazy. Watch this. Watch this.
10 years getting
So
hammered.
right here, what does it say? It says, make sure to get your coupon for Stocks and Psychology of Money before Friday at 11:59 p.m. Price is going up. Lifetime access forever. Trade alerts, course member live streams, you name it. Email staff@mekevin.com if you have questions.
Y'all should go follow
Okay,
him.
I had to do that. I'm sorry. Okay, this is 4-6. So initially we look at this and go, oh, that's good for interest rate sensitives. Buy interest rate sensitives. That was an idea going into this. The rug tug that came from the unexpected place was this change. This longer term change changes the slope of interest rates going down from, a recession decline in interest rates to a nominal decline in interest rates to a slow decline in interest rates. A slow decline in interest rates, really bad for anybody who wants to finance stuff. Really good for companies who don't care. Like, who benefits from higher GDP and doesn't care about interest rates? Well, I would call it the Big Six and chips. Big Six and chips, they win from these numbers right here. Absolutely. Interest rate sensitive, so I'll call them IS. IS lose here. Okay, that's very interesting. Wow, okay, what else are the suits saying? So, looking at suits, 6 minutes to Powell. Market moves fading now. Fading. Speak English, Kevin. Let's see. 2-year yields are off their lows. 10-year yields are back to being flat on the session. Stocks, bonds kind of rotating down a little bit now. Median projections, still historically low. That's fine. But again, we've been at 2.5 for years. And so the fact that it's trending up is just a sign that the Fed is paying attention. Like, it's a signal that people at the Federal Reserve are like, crap, this could take way longer than all of us thought and ultimately outlast all of us at the Fed. Like, they'll all end up getting replaced by other people anyway. Let's see here. Bank of America, Fed's not giving up on the 2% goal. Main message from the statement is that they're fully embracing the supply side story and that the economy can run faster without generating overheating pressure. Maybe. FOMC members generally see risks to inflation, weighted to the upside. We already knew that. Fed will maintain current pace for QT. Okay. Compared to December, Fed raised GDP forecast. We saw that. 10-year break-even rate went all over the place in the minutes after. That's not a surprise. Okay, let's look at the inflation projections charts. So those are, excuse me, sorry, got to get over this little bit of lingering sickness. We're about two hours and 15 minutes away from summer surgery, by the way. So I'm a little nervous about that. I want to be there with her. I was going to go today, but because I'm a little under the weather, I won't be there. I'm going to wait until I'm better. But she's here. She's still here. Cutie. All right. So let's look at this. We got 4 minutes to Powell. So distribution of GDP. What do we have? Unemployment rate over the longer run. This didn't really move much. If anything, it concentrated on the 4. That's fine. The blue bar is where they are in the current meeting. Yeah, this is the change. Look at that shift right there. See that? The dotted line is December. We just moved right there. That's not. This is. Oh, that's 2025. Sorry. And then we shifted a little bit on the. Wait, what is this? Longer run. Hold on. What is this? The inflation projection or the rate projection? Oh, that's GDP. Oh, sorry. Okay. So GDP shifted up. I want to find where is the. Here's the inflation number. That seems relatively stable. The longer run didn't change. Where's the distribution of the rate? Here we go. So this is the Fed funds rate distribution. As you can see, these lower ends got killed. So that lower side got killed. Oh, come on. How does that average to 4.6? Can somebody...
And while he's doing that, just want to show you guys this. 10-year is continuing on the upward trend. It started pulling back at the very beginning, but like he was just talking about, once it realized what was going on, we're developing a wedge right here. So hopefully it stays in, but we shall see.
It means somebody moved left, basically. Yeah. No. Does it? No. No, everybody moved up. Everyone moved up. You lost all of this. How did you not shift it up? The average is rigged. How is that possible? That the participants voted to go higher in that range, that 4.6 to 4.87. That's bizarre. Let's go look at the dots. J-Pow comes out in 2 minutes. But that's weird. I guess the bulk of them are here.
I have it pulled up on the other screen, so when it comes on, I'll get it pulled up.
1, 2, 3, 4, 5, 6, 7, 8, 9. 9 at 4.6. 9 at 4.6. You've got 1 at 4.4. You've got 1, 2, 3, 4, 5. 5 at 4. It's hard to tell where that is, like 8.5. If I do, I'm going to just try to do some quick math on that, because I think that's a little fugazi. Okay, so if we have... Okay, let's listen in here for a moment.
About 0.4% for the Dow, a little more than that for the NASDAQ, and a little less than that for the S&P 500.
He should be live now. Go switch to Powell, folks. Whoa, is he late? Oh my gosh, he's late. What?
Mm-hmm. There's not a single live stream.
Oh no!
Got him right now.
No way. How? No. Here he is. He's never late. That's bad.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially, while the labor market has remained strong. And that is very good news. But inflation is still too high, ongoing progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. I will have more to say about monetary policy after briefly reviewing economic developments.
Yeah, 4.8, that's the average. I totally agree. It's bullcrap.
At a solid pace. GDP growth in the fourth quarter of last year came in at 3.2%. For 2023 as a whole, GDP expanded 3.1%, bolstered by strong consumer demand as well as improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have weighed on business fixed investment. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2% over the next 2 years. Participants generally revised up their growth projections since December, reflecting the strength of incoming data, including data on labor supply. The labor market remains relatively tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 265,000 jobs per month. The unemployment rate has edged up but remains low at 3.9%. Strong job creation has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has been eased.
I got it. They're lying. Look at the average. Take a quick screenshot of that. They're lying. It's 4.83 is what it should be.
Labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressure on inflation. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.1% at the end of next year. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Estimates based on the Consumer Price Index.
Yeah, I am basing it on average. That is true. They are using median. My bad.
Rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as from measures from financial markets. The median projection in the SEP for total PCE inflation falls to 2.4% this year, 2.2% next year, and 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are coming into better balance. We believe that our policy rate is likely at its peak for this tightening cycle, and that if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year.
Yeah, when?
The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate.
There it is. There it is. Maintain longer.
We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably down toward 2%. Of course, we're committed to both sides of our dual mandate, and an unexpected weakening in the labor market could also warrant a policy response. We will continue to make our decisions meeting by meeting. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 4.6% at the end of this year, 3.9% at the end of 2025, and 3.1% at the end of 2026, still above the median longer-term funds rate. These projections are not a committee decision or plan if the economy does not evolve as projected.
Just made $6,500 on the way down. Yes! Sent that alert to everyone in Course Member Live.
Goals. Turning to our balance sheet, our securities holdings have declined by nearly $1.5 trillion since the committee began reducing our portfolio. At this meeting, we discussed issues related to slowing the pace of decline in our securities holdings. While we did not make any decisions today on this, the general sense of the committee is that it will be appropriate to slow the pace of runoff fairly soon, consistent with the plans we previously issued. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach that ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings consistent with reaching the appropriate level. Restoring price stability is essential to set the stage for achieving maximum employment and price stability over the long term. To conclude,
So
we
for those
understand
just
that our
joining
actions
in,
affect communities, families, and businesses.
Federal Reserve
across the
decided to
country.
keep rates the same.
Everything we do is
Really,
in
the only
service
thing
to
they
our public
changed was
mission.
their comments.
We at the Fed will do
and
everything we
higher
can
for longer.
to achieve our maximum employment and price stability goals.
So you mortgage
Thank you.
lenders, that's right, Steve Panate, the legend.
Steve Leisman, CNBC. Mr. Chairman, the projections show somewhat higher core inflation. They also show somewhat stronger growth. What should we infer from this notion that on average rates were kept the same this year, but inflation is higher and growth is higher? Does it mean more tolerance for higher inflation and less of a willingness to slow the economy to achieve that target?
Well, it doesn't. No, it doesn't mean that. What it means is that we've seen incoming as I pointed out in my opening remarks, we did mark up our growth forecast, and so have many other forecasters. So the economy is performing well, and the inflation data came in a little bit higher as a separate matter, and I think that caused people to write up their inflation. But nonetheless, we continue to make good progress on bringing inflation down, and so.
When you just to follow up, when you say that you're willing to either maintain the rate for longer, what is the tolerance of the Federal Reserve for inflation coming in above its 2% target?
So we're strongly committed to bringing inflation down to 2% over time. That is our goal, and we will achieve that goal.
And one of the things they did do that they kind of slid into the statement
that's what will
was
happen over
they
time. But we stress
changed their
over
really
time.
long-term
And so,
forecast
I
quite a
think
bit higher.
we're making projections that do show that happening, and we're committed to that outcome, and we will bring it about.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. You and others have been saying that relief on housing inflation is coming, but it still hasn't shown up meaningfully in the CPI or the PCE. Does that challenge
important.
your assumption about
Housing inflation.
when the shift will finally break through, since it hasn't at that point?
So I think there's some confidence that the market rents, lower market rent increases that we're seeing will show up in measures of housing services inflation over time. There's a little bit of uncertainty about when that will happen, but there's real confidence that they will show up eventually over time. But again, uncertainty about the exact timing of that.
And will you be able to get overall inflation down to target if housing doesn't break through quickly, and does that affect the timing for eventual cuts this year?
We will get aggregate inflation down to 2% over time. We will. And I would assume that what we'll continue to see is we'll see goods prices coming into a new equilibrium where they're going down perhaps not as quickly as they had been earlier this year, where housing services inflation will come back down as current market rents are suggesting.
He's avoiding the housing comment.
And where non-housing services will move back down. Some combination of those three things, and it may be different from the combination we had before the pandemic, will be achieved and will bring inflation back down to 2% sustainably.
And for those who haven't seen my video on what he said couple of weeks ago about the housing market.
Tim Russ of the Wall
Go
Street
check
Journal. Chair
check
Powell,
out my
during your
YouTube
congressional
and see what he
testimony
said.
this month, you said that your test for making the first change to interest rates does not require you to be terribly comfortable that inflation is at 2% because interest rates are well above neutral. At the same time, you said here after the last meeting that the first cut is highly consequential. Can you reconcile these views for me? If rates are well above neutral, why would the first cut be highly consequential? Is that because you anticipate one cut would be followed by one or two more along the lines of the recalibration you made in 2019, which itself was modeled on the mid-cycle adjustment of 1995?
It's more, I would put it more in the context of what I said in my opening remarks, that the risks are really two-sided here. We're in a situation where, you know, if we ease too much or too soon, we could see inflation come back. And if we ease too late, we could do unnecessary harm to employment,
AKA
and,
hard
you know,
landing.
people's working lives. And so,
What they're working on
you
now.
know, we do see the risks as two-sided. So it is consequential. We want to be careful. And fortunately, with the economy growing, with the labor market strong, and with inflation coming down, we can approach that question carefully and let the data speak on that. That's really what I was thinking.
And their dot plot did indicate 3 rate cuts this year.
You chalk up to one-off calendar adjustment
comparative
effects
to the
following a period of high inflation
5
versus
it had indicated
some
before.
change in the trend
So
we saw
a lot less rate
the
cuts
second
this year.
half of last year.
So I want to start by saying I always try to be careful about dismissing data that we don't like. So you need to check yourself on that, and I'll do that. But I would say the January number, which was very high, the January CPI and PCE numbers were quite high. There's reason to think that there could be seasonal effects there. But nonetheless, we don't want to be completely dismissive of it. The February number was higher than expectations, but we have it at currently well below 30 basis points core PCE, which is not terribly high. So it's not like the January number. But I take the two of them together, and I think they haven't really changed the overall story, which is that of inflation moving down gradually on a sometimes bumpy road toward 2%. I don't think that story has changed. I also don't think that those readings added to anyone's confidence that we're moving closer to that point. But you know, we didn't. Last thing I'll say is we didn't excessively celebrate the good inflation readings we got in the last 7 months of last year. We didn't take too much signal out of that. What you heard us saying was that we needed to see more, that we could, you know, we wanted to be careful about that decision. And we're not going to overreact as well to these 2 months of data, nor are we going to ignore them.
Hi, yes, Chair Powell. Could you speak a little bit more about the timing? Is there enough data between now and, say, May to be able to get the kind of confidence that you say that, you know, you still need? Or by June, is there enough data for you? Just give us a sense of your thinking there. Thank you.
Yeah, so we make decisions meeting by meeting, and we didn't make any decisions about future meetings today. Those are going to depend on our ongoing assessment of the incoming data, the evolving outlook, and the balance of risk. So I really don't have anything for you on any specific meeting looking forward.
But, I mean, just a question of, I mean, is there even enough data for you to be able to?
We'll take, you know, things can happen during an intermeeting period if you look back, unexpected things. So I wouldn't want to dismiss anything. So I just would say that the committee wants to see
This guy's a politician now.
more data that gives us higher confidence that inflation is moving down sustainably toward 2%. I also mentioned, and we don't see this in the data right now, but if there were a significant weakening in the data, particularly in the labor market, that could also be a reason for us to begin the process of reducing rates. Again, there's nothing in the data pointing at that, but those are the things that we'll be looking at coming meetings, and without trying to refer to any specific meeting.
Hi, Chris Regaber, Associated Press. Thank you. In the projections, there is an increase in the neutral rate, as you know, and higher rates, a quarter point higher rates projected in 2025, 2026. Can you speak about what might be behind that? Is there a real sense here that the economy has perhaps changed in some way, that higher rates will be needed in the future? Thank you.
So you're right, they're pretty modest changes, but you're right, there was an uptick in the longer run rate, and also there's a 25 basis point increase in 25 and 26. In terms of are rates going to be higher in the longer run, if that's really your question, I don't think we know that. I think we think that rates were generally low during the pre-pandemic, post-global financial crisis era for reasons that are
They
mostly
changed their prediction for the federal funds rate.
Important, slow-moving,
in
large
December.
things like demographics and productivity and that
They
sort of
changed
thing.
it up a
Things that
0.5%.
don't move quickly. But I don't think we know. I mean,
Okay,
For your
everyone, let's
business
take
to
one
succeed,
at
you need
a
to make
Fab, real pay
connections.
read.
I can help you all if you just follow.
in some cases, I don't see rates going back down to that level, but I think there's tremendous uncertainty around that.
Great. And just a quick follow on the projections, you also have 2.6% core inflation for the end of this year. It's already at, or you mentioned it being 2.8 in February. I mean, that doesn't sound like much disinflation at all. So are you still confident, or last press conference you sounded pretty optimistic you would get more confidence to the end of this year. Is it right to say that this suggests you're not seeing a lot of disinflation this year compared to what we've seen 2023 and so forth?
I think that higher year-end number reflects the data we've seen so far this year, because you're now in this year. So I think that. Sorry, say your last part of your question again.
Well, just, are you still optimistic that you'll get the confidence you need this year?
I think if you look at the SEP, what it says is that it is still likely in most people's view that we will achieve that confidence and that there will be rate cuts. But that's really going to depend on the incoming data. It is. The other thing is, in the second half of the year, you have some pretty low readings, so it might be harder to make progress as you move that 12-month window forward. Nonetheless, we're looking for data that confirm the kind of low readings that we had last year and give us a higher degree of confidence that what we saw was really inflation moving sustainably down to 2%, toward 2%.
Actually, they released their projections for anybody who wanted to see them. You can go on Twitter. I think it's
James
Federal. I think it's
Smith,
just
New York
at
Times.
Federal
Thank
Reserve.
you for
but
taking our questions.
they
A poll
significantly
commented
raised their
that
prediction
a
for
weakening
inflation,
in the labor market would be a
essentially
reason
saying
to
that it's nowhere
potentially
near done
cut
yet.
rates, or at least a consideration in making a rate cut. Would continued strength in the labor market be a reason to hold off on rate cuts? And just in general, if labor supply continued to rebound in 2024 the way it did in 2023, what would stronger hiring and possibly stronger growth mean for the path forward on policy?
Yeah. So if
Just
what
watching
we're
these
getting
rates
is
climb, Chris.
a lot of supply and a lot of
Hope you're well,
demand,
dude.
and
Love
that
your-
supply
love
is
your
actually
freaking music
feeding
on,
demand because workers are
TikTok.
getting paid and
Go
they're
check him out.
spending, and that's
Chris Reynolds.
you
I
know,
think it's Whiskey Rich
what you
on
would
TikTok.
have is potentially kind of what you had last year, which is
He's on the
a
come
bigger
up.
economy where inflationary pressures are not increasing. In fact, they were decreasing. So you can have that if you have the continued supply side activity that we had last year with both with supply chains and also with growth in the size of the labor force.
But so strong hiring in and of itself would not be a reason to hold off on rate cuts?
No, not all by itself, no. I mean,
He's a
we
politician
saw,
now.
You saw last year, very strong hiring and inflation coming down quickly.
I wish
we
he
now
was.
have a better
I'm just kidding,
sense
I don't
that
mean
a
that.
big part of that was
Except kinda.
supply side healing, particularly with growth in the
He
labor
ain't helping
force.
my
So
job, that's for sure.
In and of itself, strong job growth is not a reason, for us to be concerned about inflation.
Hi, Chair Powell. Neil Irwin with Axios. How do you assess the state of financial conditions right now, and in particular, do you view the kind of easing in financial conditions since the fall as consistent and compatible with what you're trying to achieve on the inflation mandate?
So we think there are many different financial conditions indicators, and you can kind of, see different answers to that question. But ultimately, we do think that financial conditions are weighing on economic activity, and we think you see that in a great place to see it is in the labor market, where you've seen demand cooling off a little bit from the extremely high levels. And there I would point to job openings, quits, surveys, the hiring rate things like that are really demand. There are also supply side things happening, but I think those are demand side things happening. We saw, that's been a question for a while. We did see progress on inflation last year, significant progress, despite, financial conditions sometimes being tighter, sometimes looser.
Michael McGee with Bloomberg Radio and Television. Can you give us more color on how the committee is thinking about inflation dynamics now? What we've seen at the beginning of the year, are they more one-off increases that will fade, or is there more of a secular turn with goods prices rising again and service prices staying sticky? And also, housing prices have been sort of the Godot of this cycle, in that you keep expecting them to go down and they don't. How does the committee see this playing out forward since you've raised your inflation forecast?
So I see the committees looking at the 2 months of data and asking the same question you're asking and saying we're just going to have to see what the data show. As I mentioned, you can look at January, which is very high reading, and you can, and I think many people did see the possibility of seasonal adjustment problems there. But again, you got to be careful about dismissing the parts of the data that you don't like. So then February wasn't as high, but it was higher. So the question is, what are we going to see? We tend to see a little bit stronger, this is in the data, a little bit stronger inflation in the first half of the year, a little bit less strong later in the year. We're going to let the data show. I don't think we really know whether this is a bump on the road or something more. We'll have to find out. In the meantime, the economy is strong, the labor market is strong, inflation has come way down, and that gives us the ability to approach this question carefully and feel more confident that inflation is moving down.
No, he is keeping them the same for now.
When we take that step to begin dialing back our restrictive policy.
But he's
So you've talked about the
they
desire to
basically
have confidence that
raised their
inflation is
forecasts where
continually
they
moving down. Has
essentially
the
said
recent,
that they're not going to lower them anytime
numbers
soon.
we've gotten for inflation data dented that confidence at all?
It certainly hasn't improved
more
our confidence. It
persistent
hasn't
than he
raised anyone's
anticipated.
confidence, but I would say that the story is really essentially the same, and that is of inflation coming down gradually toward 2% on a sometimes bumpy path, as I mentioned. I think that's what you still see. We've got 9 months of 2.5% inflation now, and we've had 2 months of kind of bumpy inflation. We were saying that it's going to be a bumpy ride. We consistently said that. Now here are some bumps, and the question is, are they more than bumps? And we can't know that. That's why we are approaching this question carefully. It is very important for everyone that we serve that we do get inflation sustainably down. And I think the historical record, every situation is different, but the historical record is that you need to approach that question carefully and try to get it right the first time and not have to come back and raise rates again, perhaps, if you cut inappropriately, prematurely.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, you received a letter from, the Federal Reserve, for independent body, understanding Congress has oversight over that. You received a letter from Senators Elizabeth Warren and Sheldon Whitehouse that said, calling on you to lower interest rates, to cut interest rates, because it says, quote, the potential that it may remain too high for too long has halted advances in deploying renewable energy technologies and delayed significant climate and economic benefits from these projects. So has higher interest rates caused that?
Have they? Well, first of all, I respect in our system of government, it is Congress that has oversight responsibility over the Fed. We place a tremendous amount of importance on our engagements with Congress and always treat them with great respect. In this case, I would say those are, our mandate is for maximum employment and price stability and the other things that we do. And that's what we're trying to accomplish. We're trying to do that in a way that sustains the strong growth we're seeing, the strong labor market we're seeing, but allows us to make further progress with inflation. That's how we can best serve the public and leave the other issues, which in many cases are incredibly important, such as those you mentioned, leave those to the people who have responsibility for those.
There was another letter from 24 lawmakers saying that the higher rates are squeezing the working people. How do these letters affect what you guys are doing policy-wise?
I do feel bad
We
for
receive
Jerome Powell, though.
He's
got to deal with the politicians and the public and try to keep them both
and
happy.
address concerns. We listen, again, because we're talking to the people who, in our system of government, have oversight over our activity. So that's, but at the end of the day, we take that on board, but we have to make our judgments and we have to stick to our knitting, which is maximum employment, price stability, supervise and regulate the banks, work on the payment system, the things that we do.
Claire Jones, Financial Times. Thanks a lot for the opportunity to ask a question. As chair of the FOMC, would you want to see unanimity on the committee or something close to it, meaning no more than one dissent before you begin cutting rates? Thank you.
We're a very consensus-oriented organization, and we do try to achieve consensus and ideally unanimity. People do dissent. It's something that happens. Life goes on, and it's not a problem. We've always had dissents, and so and you respect thoughtful dissents very much. It's like you may not agree with some arguments, but you really want to understand them. So you may read a book that takes a position that you have long opposed, just to understand that book. So I treat dissents with real respect as well.
We should treat these damn rates with respect.
Simon Urbanovich with The Economist. Can you hear me?
Yes.
Okay, great. Obviously, inflation is some ways away from target. Unemployment, though, if you look at the projection for the full year, 4.0%. In February, we were already at 3.9%, so quite close to the median projection. Are you concerned at all that, notwithstanding the very strong jobs growth, that in fact there may be some cracks appearing in the employment market? You talked about a significant deterioration in the labor market being a condition for easing rates. What would constitute that in your books? Thank you.
So
one of the things
we,
that,
of course, monitor it's one of our two goal variables. We all monitor the labor market very, very carefully, and I don't see those cracks today. And we follow all the possible stories that are out there about there being cracks. But the overall picture really is strong labor market. The extreme imbalances that we saw in the early parts of the pandemic recovery have mostly been resolved.
Stone Temple Pilots and live the Jubilee Tour, featuring dates with special guests.
Levels, in many respects, things are returning more to their state in 2019, which we can think of as normal for this purpose. That's job openings and quits, and surveys of workers and businesses are always interesting on this. How tight is how easy is it to find a job? How easy it is to find a worker? Those surveys have both come down.
One of the things that annoys me
the labor
about this
market's
is that
it's in good shape.
We're still not even back to pre-pandemic levels of employment, and you hear all these people talking about, oh, the job market's great.
People have made the argument
if you actually
that
look at the data, all of
if
it's part-time
layoffs were to
jobs.
increase,
Americans can't afford shit.
That would mean that the net would be fairly quick increases in unemployment. So that's something we're watching, but we're not seeing it. Of course, initial claims are very, very low, and if anything, have tracked down a little bit. So watching it carefully, don't see it. And when I say something, I use the term unexpected weakening in the labor market. So, we do expect the unemployment rate to, the forecast is that it would move up, I think, closer to what we see as the longer run sustainable level. That's just people's forecast, individual forecasts. But we're talking about something that's unexpected. That's where I'll leave it, though.
Steve Matthews with Bloomberg. You mentioned at the beginning of the press conference that the committee felt it might be appropriate to slow the pace of asset runoff fairly soon. I'm wondering, when you say fairly soon, does that mean that the committee would meet about this again in May, and a decision could be reached that soon. And I was wondering if you could also just describe the scope of what the committee is discussing here. You're at $95 billion of caps right now. Would that be cut about in half or something in that nature? Thank you.
So that is what we're discussing essentially is and we're not discussing all the many other balance sheet issues. We will discuss those in due course, but what we're really looking at is
He's a politician now, Chris.
slowing the pace
Can't
of
get any
runoff.
freaking
There isn't
answers
much
out of
runoff
him.
among MBS
know why I'm
MBS
even
right now,
watching
but
this
there is in
crap.
treasuries, and we're talking about going to a lower
More for
pace.
entertainment than
I don't
anything.
want to give you a specific number because we haven't had an agreement or a decision, but that's the idea. That's what we're looking at. And in terms of the timing, I said fairly soon. I wouldn't want to try to be more specific than that, but you get the idea. The idea is, and this is in our longer run plans, that we may actually be able to get to a lower level because we would avoid the kind of frictions that can happen. Liquidity is not evenly distributed in the system, and there can be times when, in the aggregate, reserves are ample or even abundant, but not in every part. And those parts where they're not ample, there can be stress, and that can cause you to prematurely stop the process to avoid the stress, and then it would be very hard to restart, we think. So as something like that happened in 19, perhaps. So that's what we're doing. We're looking at what would be a good time and what would be a good structure, and fairly soon is words that we use to mean fairly soon.
And will there be a discussion about returning to an all treasuries balance sheet at some point?
So that our longer run goal is to return to a balance sheet that is mostly treasuries. I do expect that once we're through this, we'll come back to the other issues about the composition and the maturity and revisit those issues. But it's not urgent right now. We want to get this decision made first, and then we can, when the time is right, come back to the other issues.
Hi, Victoria Guida with Politico. Also on the balance sheet, can you talk a little bit about how the outlook for the banking sector might impact your balance sheet plans? Do you worry that as deposits start to shrink that we could see more turbulence?
We'll be watching carefully, but one of the reasons we're slowing down, we will soon enough, fairly soon, I should say, slow down, is that we want to avoid any kind of turbulence. I wasn't thinking particularly about banking sector turbulence, but we had some indicators. The last time, this is our second time in doing this, and I think we're going to be paying a lot of attention to the things that started to happen and that foreshadowed what eventually happened at the end of that tightening cycle, where we wound up in a short reserves situation, and we don't want to do that again. And I think now we have a better sense of what are the indicators. It wasn't so much in the banking system as it was around, for example, where federal funds is trading relative to the administered rates, and where secured rates are relative to the administered rates. Those sorts of things. We will always be watching the banking system for similar signs, though.
Well, is it also because you're not sure exactly how the reserve supply will react once the overnight reverse repo facility, drops near at zero?
I think we broadly think that once the overnight repo stabilizes either at zero or close to zero, that as the balance sheet shrinks, we should expect that reserves will decline pretty close to dollar for dollar with that. That's what we think.
Hi, Chair Powell. Jean Young with M&I Market News. I wanted to ask also about the balance sheet. You said that starting the taper sooner could get you to a smaller balance sheet size. Does that mean you don't have to make a decision on when to end QT at this point? And will you be setting up the process for deciding that sooner, or will you wait until we're close to the end?
So it's sort of ironic that by going slower you can get farther, but that's the idea. The idea is that
That's what she said.
with a smoother transition,
Sorry, I should have said
you'll run much less risk of
But I can't help it.
kind of liquidity problems which can grow into shocks and which can cause you to stop the process prematurely. So that's where, in terms of how it ends, we're going to be monitoring carefully money market conditions and asking ourselves what they're telling us about reserves. Are they, right now we would characterize them as abundant, and what we're aiming for is ample, and which is a little bit less than abundant, right? So
I can't
there
help
isn't
it. That's what she said,
there's
Joe.
not a dollar amount or a percent of GDP or anything like that where we think we have a really pretty clear understanding of that. We're going to be looking at what these, what's happening in money markets, in particular, a bunch of different indicators, including the ones I mentioned, to tell us when we're getting close. Then, though, you reach a point ultimately where you stop allowing the balance sheet to run off, but then from that point, there's another period in which non-reserve liabilities grow organically, like currency, and that also shrinks the reserves at a very slow pace. So you have a slower pace of runoff, which we'll have fairly soon. Then you have another time where you effectively hold the balance sheet constant and allow non-reserve liabilities to expand, and then that ultimately brings you ideally in for, brings it into a nice easy landing at a level that is above what we think the lowest possible ample number would be. We're not trying for that. We want to have a cushion, a buffer, because we know that demand for reserves can be very volatile, and we don't want to again find ourselves in a situation where there aren't reserves. We have to turn around and buy assets and put reserves back in the banking system the way we did in 2019-20.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, you said you're waiting to become more confident that inflation is getting to your 2% goal before you cut rates. Can you just sum up more specifically what data you're looking at that would give you that confidence?
Sure. So most importantly, we're looking at the incoming inflation data and the contents of it and what they're telling us. So that'll be, and also the various components. So obviously that's what we want. We want more confidence that inflation is coming down sustainably toward 2%. And I mean, of course, we'll also be looking at all the other things that are happening in the economy. We'll look at the totality of the data, including everything essentially, as we make that assessment. But the most important thing will be the inflation data that's coming in.
Well, are there things that you would give more weight to, like wages?
Wages is one thing. We don't. Our target is not wages. It's really inflation. But we would look to the fact that wages are still coming in very strong, but they've been wage increases. That is to say, wage increases have been quite strong, but they're gradually coming down to levels that are more sustainable over time.
All right, he's going to bore me to death.
And that's what we want. We don't think that the inflation was not originally caused, I don't think, mostly by wages. That wasn't really the story. But we do think that to get inflation back down to 2% sustainably, we'd like to see, continuing gradual movement of wage increases at still high levels, but back down to levels that are more sustainable over time.
Go to Greg.
Thank you. Greg Robb from MarketWatch. Chair Powell, could you say at this meeting whether there were more officials who wanted to be careful and go slower about rates than were at the last meeting? Was there that sense of maybe it's smart to wait? Thanks.
I guess I'd put it this way. If you look at the incoming inflation data that we've had for January and February, I think very broadly that suggests that we were right to wait until we're more confident. So I think I didn't hear anyone dismissing it as not information that we should look at or anything like that. So I think generally speaking, it does go in the direction of saying yes, it's appropriate for us to be careful as we approach this question.
Thanks, Chair Powell. Brendan Peterson with Punchbowl News. I wanted to ask you about central bank digital currency stuff. We've been hearing a lot from Republicans in Congress about.
May I present Willy Wonka's Wild and Wonderful Wishy-Washy Wonka Walker? Please don't make me say that again.
What's
going on here?
We're going to wait for approval before the Fed does anything, launches anything. But folks like House Majority Whip Tom Emmer have said that the Fed is either actively researching or hiring personnel to study the implications of the CBDC. Can you give us any clarity on what the Fed is doing right now on a digital dollar?
Sure. So I think we've been pretty transparent on this, but I'll try harder. So we are not getting ready to, we haven't proposed, we haven't come to a conclusion that we should propose or anything like that, that Congress consider legislation to authorize a digital dollar. And it would take legislation by Congress signed by the president to give us the ability to do what we think of as a CBDC, which is really a retail CBDC with the public of it. So we're just a long, long way from that. What we are doing, and I think what every major central bank is doing, is we're trying to stay in the frontiers of what's going on in digital finance. And it has many, many different areas. You know, it has applications in wholesale finance, in the payment system.
God, he's good at politics.
And so we to serve the public, these issues have become very front burner in the last 5 or 6 years. We need to be knowledgeable about all that. So we actually do have people trying to understand things that are, but it's wrong to say that we're working on a CBDC and then we've secretly got a lab here where we've got one and we're just going to spring it on Congress at the right moment. We don't. I haven't at all in my own mind made a decision that I think this is something the U.S. should be doing. You know, I just think it's something we need to understand, and we do have people who are keeping up with that as part of the broader payments landscape. That's how I would characterize it.
Market is so choppy.
Thank you. It's Mark Hamrick with Bankrate. Mr. Chairman, April 27th will mark the 13th anniversary since a Fed chairman began holding regular news conferences. How important has that higher transparency been in your view, both for the proper functioning of the central bank and also in accomplishing your mission? And is there more that you and your colleagues can do on the transparency front, and what might that look like?
I generally think, I mean, this movement actually started, 30 years ago, when some academics posited that a more transparent central bank, if the public understands your reaction function, the markets will do your work for you. They'll react to the data. And so it all happens that way. And so there's been a march toward greater and greater transparency. And that certainly Chairman Bernanke advanced that, so Chairman Greenspan did, Chair Yellen did. And so we went from four press conferences a year to 8, so now every meeting really is live now. I think that's a good innovation. I wouldn't want to turn it back. We also have done a bunch of other things. We have an annual supervision report, financial stability report. I mean, there's a long list of things that we've done. I think nothing comes to mind as really desperately in need of doing at this moment. We're very transparent. We have no shortage of FOMC participants speaking to the public through the media. And so that channel is full, I would say. So I think it's generally broadly helped and made things better, but not every day and in every way.
Well, to follow up, has there ever been a day where you wanted to put that genie back in the bottle somewhat?
Of course not.
Let's go to Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. Not to harp too much more on confidence and inflation, but you did say earlier in this press conference that the recent inflation data hasn't raised anyone's confidence. But when you testified before the Senate a couple weeks ago, you told lawmakers that you are, quote, not far from receiving the confidence needed on inflation to begin cutting rates. So are you still of that belief or not? What are we to take by those words, not far?
So let me say my main message at that in those 2 days of hearings was really that the committee needs to see more evidence to build our confidence that inflation is moving down sustainably toward our 2% goal, and we don't expect that it will be appropriate to begin to reduce rates until we're more confident that that is the case. That is the case. I said that any number of times, so those were kind of the main part of the message. We repeated that today in our statement. I also, to the language you mentioned, I really pointed out that we had made significant progress over the past year, and what we're looking for now is confirmation that that progress will continue. We had a series of inflation readings over the second half of last year that were really much lower. We didn't overreact, as I mentioned, but that's what I had in mind.
But given that you said that PCE for February, 2.8%, the estimate, and that we have been seeing PCE, core PCE, coming down by 10% every month, I mean, wouldn't you be at about 2.4% this summer, June, July, to a point where you could cut then?
Well, we'll just have to see how the data come in. We would, of course, love to get great inflation data. We got really good inflation data on in the second part of last year. Again, we didn't overreact to it. We said we needed to see more, and we said it would be bumpy, and now we have January and February, which I've talked about a couple of times. So, we're looking for more good data, and we would certainly welcome it.
Thank you.
Thank you.
Okay, let's go back over to Kev. Can I get a breakdown of what he thinks? He is more intelligent than I. Let's see here.
Might be an opportunity to trade going into the release, but then get out potentially before Powell speaks, because everything changes when Powell speaks all the time. And so that's what I did over here on Enphase. And so I'll talk about that in just a moment. So let's get into the summary. Okay, summary, here we go. Wow, the Federal Reserve just tugged us in a location we were not expecting to get tugged in, and I made a trade during this press conference, well, actually right before the press conference. Was it profitable? I went into this Fed day with no positions, did have positions over the last few days. I send out all my alerts to Stocks and Psych course members. Well, during the, right after the release of the information, I ended up going short Enphase after it ran all the way up to this 113 line, went short right about here, rode it until we started moving back up. Obviously, I wish I closed it at rock bottom. I would have been up 10K, but I closed it up about 6,500 bucks. I have that trade confirmation right here, so you can see the option that was traded, and you can kind of match that up with the prices, and you can see it. So anyway, let's get into the summary. If you want all those alerts, be a part of Stocks and Psych. Price goes up on Friday. You get lifetime access to all trades forever and course member live streams. You don't even have to watch the course lectures if you don't want to. Although there's good content in there anyway. Now, let's talk about the Fed. Wow. Okay, first we got to look at the statement, because the different rugging that we got here was a little bit of a surprise. I certainly was surprised. Bank of America nailed this segment right here. Bank of America nailed the steady 4.6 and the 4.9. Now keep in mind, that is steady 4.6 on a median basis. On an average basis, this number went up. If you jump on over to the dot plot right here, and you see what's happening right here, we calculated out roughly what we think actually that median projection or the average projection went to. The average projection went to about 4.83. My prediction was we were going to go to 4.8. We're right on the average, wrong on what's on the form. The form calls for median. Oh well. So it is interesting because you did see a move up, but even though you saw a move up, it wasn't enough to change the middle number, the median number. So that was a surprise. That's surprise number one. Surprise number two was right here. We suggested this could happen, and it happened. It happened. But I didn't think it was going to happen this meeting, because I thought we were going to revise this up, and we weren't going to touch this yet, but eventually we would. Well, we touched it. We went to 2.6 from 2.5 for the longer term rate. What does that mean? Well, it makes this very simple, folks. In a recession, you get interest rate sensitive stocks that can win. Why? Because rates go from high to low very quickly. Interest rate sensitive, happy. If you have a downward sloping curve, interest rate sensitive stocks are mostly happy. If you have a slower downward trending curve, interest rate sensitive stocks are a little less happy. And obviously, as interest rates are going up, interest rate sensitive stocks are sad. And of course, the higher they go, the more sad they are. Okay, that should be pretty obvious. Very, very simple. See the difference in the lines? Okay, you get it. So, what else did we find here? This was a massive beat. I did not think we were going to come in this high on GDP at all. In fact, if we go to my projection, I thought we were going to be 16, 18, 19. I thought they were going to keep steady, 25, 26, revised up 24. Instead, they revised up everything. Everything over 2%. Really impressive. In my opinion, this is good news. Both of these factors combined, in my opinion, is actually really good news for the market broadly. Chips, big tech, big corporations, cash-rich corporations. This is a win for big companies. This is a loss for the interest rate sensitive. Now, we did, excuse me, we did maintain the 3 cuts, but Jay Powell told us roughly when he thinks by implying it with some statements. First of all, he said that, quote, "We are prepared to retain the current rate for longer." And then later in the presser, he decided to say, hey, we are in a position where we're trying to compare to last year's inflation data to make sure that we're actually making progress on inflation. Okay, that's problematic. Why is that problematic? I'm going to map this out for you, okay? This is really simple. When are the next Fed meetings? Well, mark your calendar. I'm about to tell you. All right, ready? May 1, June 12, July 3, 1. That's the beginning of Q3 right here. This is Q2, okay? Market right now thinks we're going to get cuts here. I think the market's wrong on that. I'm going to show you why. I think they're going to happen right before the election. Watch this. Sept, November, December, okay? That's Q4 right here. So, what do we have September? September 18th means we're actually going to get the August data because the August CPI data will be out already. November 7th, that's right after the election, which maybe they'll even wait until after the election, although I don't think so. So here's my take. If we go 3 cuts in order to lap the data, I think if we go 3 cuts, what we're going to get is we're going to get 25, 25, 25. That adds up to 3 cuts. If we end up going 2 cuts, okay, 2 cuts, the benefit of waiting until after the election will mean the Fed will not look politicized. 25, 25. What does this give the Fed? This gives the Federal Reserve the ability to lap the second half of the year with last year, 2023. And then they'll be able to confirm the 12-month disinflationary trend. So even though we're still showing that 3 rate cut trajectory, I do think it's going to be later, especially since Jay Powell told us today, quote, we are prepared to retain the current rate for longer. It's worth noting that Jay Powell was also about 15 seconds late. That's only notable because he's like never late. It's kind of like when I do the stock market open live stream. Every morning, by the way, at 5:25, totally for free on the Meet Kevin Live channel. We go live for like an hour and 20 minutes and we talk trades and market news and stuff like that. And then we go into the course member live stream after that for about 30, 40, 50 minutes. Anyway, I don't even know where I was going with that. Whatever, it doesn't matter. Okay, so let's move on to, I literally forgot what I was going to say there, but that's okay. Getting into the rest of what Jay Powell said, we'll go there. So quantitative tightening. Jerome Powell, when it comes to quantitative tightening, is expecting to begin QT sooner. It's going to begin, oh, Powell was late, that's right. I was going to make a joke that if somebody told you Kevin was 1 minute late to the market open live stream, everybody would be like, that's not news. He's like late every day, 1 minute. You know, Powell being late is news because it's different. Thank you for catching me up in the comments there. Appreciate that. Okay, so regarding QT, I think Jay Powell is going to go for QT soon. He says, we're ready fairly soon. That was his quote. But why do I think that makes sense? Because if they're not going to cut rates until the end of the year, guess when you can go do QT? Go do QT now. Start QT here. QT start. So the reduction, right? The slowing of QT can begin in the second quarter. So you slow QT in the second quarter, and then you do the rate cuts at the end of the year. Okay? That's a potential strategy. I think that's probably right. Okay, so 3 rate cuts still on deck for the year. However, that longer term figure moved up. Nick T immediately picked up on that and commented that that longer term rate going to 2.65 is really the progression of this upward drift, that maybe rates will be higher and we won't go back to the levels we had previously. Jerome Powell did also suggest that we probably won't be going back to the 0% we used to have or the low rates we used to have. So that's sort of reiterating what we see here. Inflation is still too high, he says. We've been averaging 265,000 job gains. The economy is doing very strongly, and we're going to slow the pace of QT fairly soon. Inflation data has come in a little higher, but that was a separate matter because we're making good progress on inflation. Really, there's a good reason to believe that the January numbers, even though they were quite high, there's reason to believe they were seasonal. And so he doesn't want to be completely dismissive of January, but he does say, hey, let's just see how the data evolves. You know, that could average out. Now, February was also high, but Jerome Powell says not terribly high. So he's actually dovish. He didn't. I thought he was going to come in with a tilt to the hawkish side. We got a tilt to the dovish side on Powie Wowie here. So good job on Powie. Now, higher. By the way, one of the strategies we made this morning was if we had 4.6 or lower, go long triple QQ or Tesla.
You guys have a kick-ass day. Make sure you hit that follow button
and straight up soon. I can actually show you this. I just zoomed in on this really quick. This was one of the things we talked about in the course member live stream this morning. I forgot I had this.